You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello, welcome to The Investor Way with me, Sam Ball, and John's not with us this week, but we are joined with a special guest, Flosser Invest. So, first of all, thank you for coming on the podcast today, Flosser.
Thanks for having me, Sam. Really delighted to be here.
So, for anyone who doesn't know Flosser, you can follow him on Twitter at Flosser Invest, which I'd say is definitely worth doing, by the way. But for anyone who doesn't already know you, do you want to just talk a bit about how you became interested in investing and how you got to where you are, really?
Sure. So, I mean, I had a good think about this, and I'd say my initial interest goes back to childhood. And there's a few key points that I'll just elaborate on. So as a child, my dad was a financial advisor for a big kind of insurance company, and he used to sell unit trusts and funds and this kind of thing. So I used to overhear and talk to him about it and that kind of thing. But in terms of shares, and I don't know how old you are, Sam, but I'm
25.
25, so this is way before you were born. But in the 1980s, when I was like 10, 11, the government at the time was privatizing a lot of industries. So BT in 84, British Gas, British Airways, and this was quite a big thing. There was these massive TV campaigns. I remember there was one called Tell Sid for British Gas, and all of a sudden people were able to own these shares, and my dad took part in these, and I think 5 million people overnight became private investors. And I was like, something triggered. Wow, you actually own a bit of a company. So that was my sort of first awareness of shares. And what very, very sad, but during school holidays, before the internet, there was something called teletext on television. Did you ever come across that?
I did come across it.
Yeah. So CFAX, which was BBC, you used to go on a page and you used to be able to see share prices. And I used to pretend I had like 100 quid and buy all these and pretend to buy shares at the beginning of a day in these like 1980s companies, Cadbury, Schweppes, ICI, and then see how much money fictional money I could make. So that was a kind of as a child. But then later on, the thing that really triggered was Apple, where I was a fan of Apple I became a massive fan of Apple as a consumer. So I bought an iMac, this model they had, the G4, which had this dome. It was only around for a year, and then the iPod in 2001 and 2007. And I had a look at them as a company, and I was like, hang on a minute. If I'd invested in Apple shares in 2002, then by the time they launched the iPhone, they would have gone up 15 times. And I was like, well, I'm a fan. I love this company. Why didn't I do that? So from that moment, I started playing around a little bit, mainly with funds rather than shares. And then in about 2010, I made the decision to start getting more serious and buy some actual companies. And I also found out about ISAs, where then I think you could invest like £10,000 in an ISA. And I decided, right, I've got my pension, and that's the sort of safe bit. So I'm going to have a bit more adventure and risk, and took the decision then to start building some positions and portfolio and accept a high level of risk. And that's just carried on. I've just regularly dripped in month after month a small portion of my income until today.
Okay, so what was your pension in, if you don't mind me asking? Was it just a default plan, or
a default company plan? And it still kind of is, to be honest. So I see that most of my pension is in kind of tracker funds, where it kind of gets adjusted depending on your age and lifestyle. So the way I see it, that's almost like a passive side of my that's a kind of safe bet, passive, and part of my investing that I don't really touch, and that tracks the market in the long term. And that gives me the confidence to be more active from a kind of shares portfolio point of view that I manage mainly through ISAs.
Okay, so when did you, because Apple is in your portfolio now, so when did you actually buy it then? Was that one of the first stocks that you bought?
It was in that initial group. Yeah, I mean, I did have the share I'd had for longest was Unilever, because I'd started my career there, and there was a kind of share scheme, and so I'd already kind of held Unilever for about 10, 12 years. But then I filled out my, what's the form called, a W8 Ben form,
Yeah.
and then set up a Hargreaves Lansdown account, and then I started buying into some some of the bigger emerging American companies like Amazon, like Apple. Apple was one of the first. That was about 2011, 2012, I would say. And I started sort of building a portfolio from there on in. And then, so initially it was, it was probably more mixed UK and US positions, but over time, I probably weighted more attention to US. So initially some of the kind of big global brands and players like Starbucks and Disney, for example, but then Amazon, Facebook then floated. I took a position in Facebook, and then built out from there. And as I got more confident, I sort of built more of a view of what kind of allocation I wanted as well.
Okay. I'm basically just going to ask you to brag a bit now, but would you mind talking about your actual returns that you've had? You don't need to give any, obviously just percentages are fine, but in terms of how it's gone since you started 10 years ago, because looking at your Twitter profile, your returns are absolutely staggering, to be honest. Yes,
no, thank you. Yeah, it's really interesting, because my expectations when I set out were I wanted to kind of, I knew the long-term performance of the market, like the S&P is like what, 9% or 8 or 9%. So I was like, okay, I want to beat that in the long term. So if I get a CAGR of 10, 11% a year, then I'm pretty happy with that. And I've got kind of spreadsheets that I kind of model. Okay, what would that, if I keep on dripping in each year and I get that kind of return, what does it give me over a 20-year period? But I don't know, I've been partly I've been lucky. But partly it's been good choices, because you have to actually be in the game to win. My gains have been way ahead of that. So I don't know what my CAGR in the last 6-7 years would be, but certainly the last few years it's been in the 20+%, and in the last year was by far, as it was, I think you were talking in one of your Christmas podcasts, you had a great year as well, but it got into 3 figures, so 100%, and within there are some really, there are some 20, 15 times and 20 times, and then the one that sticks out, which is Tesla, which I think I'm at 85, 86 times now. So yeah, I mean, I'm it's not bad. So I've got about 55, 60 positions, and I think about 30, 35 of them are at least doubles. And then there's several kind of 5, 6 times, and then I think my top, maybe I've got 8 or 9 that are 10 times ish. So it's yeah, no, it's been good. It's been good, but I have a very, very kind of long-term perspective. I hate selling, but I think that, and I'm scared of selling, and I think that's helped me. And the other thing is, and this is probably not healthy, because I know you're quite rigorous around valuation, but I form an emotional attachment to some of my shares. I like being part of the story. So I like being I know I'm a teeny tiny owner, but I like that, and I don't want to walk. If I believe in the company, I don't want to walk away from that, and I like getting involved with the products and services that my shares offer. So Apple was the first example. Tesla, I've had a Tesla Model S for 4 or 5 years. I'm a super fan there as well, and many of the others. Yeah, so it's been a nice journey.
So do you want to just talk in a bit of detail about what it is you actually look for? Because you're obviously, I think, what did you say, like 35 doubles, 10 baggers, and an 85 bagger? That's obviously, it's not just luck, is it? There must be something about the companies you're identifying that seems to be working.
Yeah, I mean, the way I structure, probably the best way to describe it is to think about allocation, actually, and how I like to split my portfolio. So I've got, I'd say 50% what I aim for, and this isn't what I have, but what I aim for are 50% of my portfolio. I aim for the kind of, I call them ballast stocks. So, you know, stocks that give stability and heft, but still can grow and compound over a long period of time. So these are kind of foundation, solid, high cash generative, global brand, world beaters. You know, I characterize the FANG stocks here. I'd characterize companies like Unilever, Diageo, Starbucks, these kind of, you know, big, you know, some of them who pay dividends as well. So that gives my portfolio heft. And with those, if you think about it, some companies transition from growth stocks to kind of those more solid stocks. I mean, so a company like Microsoft, is that a growth stock, or is it like a ballast kind of heft stock? It's probably somewhere in between, because it's still growing torridly. Then I aim for about 45%. And this is probably where most of my focus goes, because I think with those global brands, you can kind of forget about them and just leave them there for 20 years. 45% is in growth stock. So these are kind of companies that operate in big kind of secular trends that are defining our economy and the way we live day to day. So in e-com, in software as a service, advertising, you know, up and coming brands, disruptors, but ones that are building scale. They're not tiny. So, you know, this is, you know, the Teslas, the e-com space. Obviously you've got Amazon, but I've got Mercado Libre's been, I think, my second best winner. Sea Limited in the Southeast Asia, but then some of the advertising plays, Pinterest, Shopify, Etsy, these kind of companies. So that's where most of my focus goes, and that's probably, I aim for about 45% of the focus, and that's probably where I've had the most success. And then I try and put, say, 3 to 5% in what I call moonshot. So these are kind of small cap, early stage, and who knows if it will come off. But if it, you know, if it doesn't come off, it's 5%, and it's not going to damage my overall portfolio. So I've got 4 or 5 positions there. And, you know, again, I'd say a few of the big positions I've got. So Mercado Libre, which is my 3rd biggest position now, and growing still. When I bought that, you know, I considered it a moonshot. Quite frankly, it was a small emerging Latin American e-com play, and now it's grown to be, you know, quite a substantial position in my portfolio, 6 or 7%. So that, yeah, it's very US weighted rather than UK. I think the nature of business, you know, I think the US companies in the US are the ones that are leading the equivalent of whatever our equivalent of the Industrial Revolution is, but for now I don't know what we're calling it, technology revolution or information revolution. So I am heavily, you know, 80-85% weighted US, but that tends to be my approach and the companies that I look for. But brand and business model is really important in that kind of middle growth area. So I love companies like Peloton, for example, that, you know, announced results last night. I know you guys have spoken about that one as well.
Yeah, so do you want to, I may as well actually skip to it, because I think that was one of the listener questions, wasn't it? It was, how are you enjoying your Peloton, and do you think that home fitness is here to stay then in a post-COVID world?
Yes, I love it. I absolutely love it. So I got it at the beginning of January, and it's a beautiful bit of kit. It reminds me a bit of when I was first got kind of shiny Apple products. So have you used one, or do you ever do spinning, Sam?
I haven't used. I've got a rowing machine, and that's it.
Okay, well, I mean, it's such a smart bit of kit. So obviously you've got this big screen, you've got this speaker at the top of the screen that when at full pelt, it's like you're in a gym. And then the way spinning works is you increase resistance, you know. So, but what this does is that the instructor will say, okay, move your resistance up 10 points, and it will do it automatically. So it will actually, and it will measure your heartbeat. So I think yes, I do think it is here to stay post-COVID, because I think they've got something there. They've almost got a bit of a cult following in terms of, you know, the business model's great. You spend quite a lot on the kit, and it's a bit of a razor and blades, you know, £40 a month ish, but it's got a kind of a cult appeal, and they're very, very clever. The way they use music, and the way they team up. They've teamed up with Beyonce. They've done a Beatles kind of feature. So I think it's a brilliant product, and I think it's a great company. And I think they're right at the beginning. You know, they only sell 3 products, 2 bikes and a tread. They're only in 4 markets. And the tread isn't even out really in the US, and the addressable market for treads is 2 or 3 times the market for bikes. So yeah, I love it, and I'd recommend it, and it's got very, very high retention rate for those who buy into it as well.
I think your opinion of the company has changed since you became an owner of the product.
Yes, it has. I mean, I think I actually, you know, if we look at if we go back a year, it's a company I ridiculed. I don't know if you remember the ad campaign they ran in December of 2019, where this guy, did you see that? A guy gifted
I've not seen the ad, but I know they had some blowback for it.
Oh my goodness, it was awful, and you know, they were called out for being out of touch and sexist, and I think they lost 1.5 billion off their market cap. But so I thought, who's going to pay that much for $2,000 for a bike and then 40 quid a month? But then somehow they turned it round, and you know, they sort of put their hands up, and you know, I don't know what changes they made in their kind of marketing team, but they just all of a sudden made it a very appealing. I think their instructors are absolutely brilliant, almost like celebrities. And yeah, I went from sort of thinking why would you to being a bit of a super fan, but I do have a tendency that's a bit dangerous, because I can get a bit sucked in, and that removes a bit of objectivity in a way from looking at my companies. I get emotionally attached.
No, I think I'm a bit similar to you on the Peloton. I did used to ridicule it.
Okay.
And now I completely get it. I completely get why people like it as a business. My only issue is the amount, the size, the amount it's gone up by since I was ridiculing it. So if I'd realised earlier, I think I would have bought it. But I feel like I missed that one a bit now.
Well, you know, you say that, but I think that's been thinking you've missed the boat is one of the biggest things I've learned to be cautious on. You know, I think when I bought, I had exactly that same emotion when I first bought Amazon. Okay, so I bought Amazon. It was about $250, and you know, that was in about 2012 or so, and it had already run up about 70 or 80 times from the late 90s, when it was the world's biggest bookstore. Yeah. And I was like, well, I've missed the boat, haven't I? You know, I think it was like 150 billion market cap. And I was like, I always was putting off buying it, and I thought, well, I'm gonna do it. I'm gonna put a little bit in there. And then since then, it's you know, that's been another kind of 11x for me in 7 or 8 years. It's like 1.7 trillion now. So I think you say that you might have missed the boat on Peloton. I think it's like 40, 45, but I think it's with the runway it's got, there's no reason why in say 2 or 3 years it couldn't be a 150, 200 billion business if they carry on and they can expand geographically in the range and keep the sort of torrid growth they're seeing. Then I think that's possible. I really do.
No, I do completely. I completely understand. Yeah. It is a business I've got a lot of respect for. I think a lot of it with Peloton as well is, I think only like 20% of the revenue at the minute is coming from the actual software sales. So much of it is still the actual devices, and it's if they can get that transition to the higher grossing software,
absolutely,
the numbers they soon start to make sense. I do.
Yeah, absolutely, absolutely.
So do you find then that pretty much all your focus is now on the US, or do you look at the UK at all, or is it just
a lot? It's a lot. I think, you know, I explained the reasons why earlier. It's where all the action is, and not just, it's not really necessarily about the US economy. It's the US stock market is also the window for the biggest global businesses, but also businesses in other parts of the world, you know, Latin America, China, you know, even Africa. I do look at the UK. I think, you know, valuations in the UK are far more reasonable, but it's the makeup of the UK stock market is very, very different, isn't it? I mean, there's some brilliant businesses in the UK, but they tend to be more traditional in a way, so sort of solid, reliable, local or global businesses, very great cash flow, and brilliant, actually very attractive for income and dividends. You know, so obviously the Unilevers, Diageo, I'm building a position up in. But then, you know, a lot of the other segments, supermarkets, that's a very, very difficult segment. It's so competitive. The margins are so low. You've got oil companies, mining. So these are, they're slightly kind of old economy products. So I would expect I'll own more and more as I grow older. I do have a couple of growth stocks. I've got Fever Tree. I think you were talking about that last week or the week before. So I've had Fever Tree for a few years as an example, and I've got a few dividend plays here and there as well. But it's not for me. It's just not as dynamic or exciting in terms of growth. That's my opinion. I mean, I don't know. What do you think? What's your perspective on it?
I generally agree. It's something John talks about quite a bit, or he does say I think what's really lacking in the UK market is we don't really have a technology. We don't really have much of a technology focus. Like if you look at the actual tech companies, there's not. You could run through the list and like you could without even looking at it, you could probably name most of the ones on it that fall into the category. I think there are some very good companies on there, and I think there are some valuations are particularly quite attractive.
Yes.
I think with the US, it is generally better companies, I think. But the problem I have with it now is just the valuations. So many people have realized that the valuations are just so much larger than they were. I mean, if you remember like 2 or 3 years ago, some of the businesses, some really great businesses were trading at valuations that in hindsight were really, really inexpensive. And I think people have realized just how valuable some of these businesses are. And I do think in the UK, there's a few businesses like that where if they were in the US, they would have a much higher multiple. So one that I like a lot is Money Supermarket, and it's got about a 4% dividend. I think it's on a normalized price to earnings. I can't remember off the top of my head. I'd say somewhere between 13 and 17. And the business has, say, doubled in the last 5 years. Or maybe it's somewhere between 50 and 100% growth in the last 5 years. And I think if you looked at that and what it would be trading for in the US, it would maybe be more like 13, 17 times sales rather than profit. So I think there are some very, very good companies in there, but there's also a lot of average companies.
I agree, and I think there are some key structural factors that are driving that at the moment. So I think in the UK, the market's been a bit beaten down by Brexit and uncertainty around that. Whereas if you look at in the US, I completely agree with you. Valuations are massively lofty, but there's some huge triggers for that at the moment. If you look at all the stimulus that the government is giving people kind of checks in terms of stimulus, I think it was $1,200 or what have you per family or what have you. And if you look at the penetration and awareness of stock market investing, the barriers to investing are so much lower. The whole Robin Hood culture. So that's far more developed in the US. And quite frankly, there's nowhere else that attractive to invest money at the moment, with interest rates so low as well. So I think there are a number of factors kind of bubbling up together that are influencing in the US. I think we've got I think it's a bit of a challenge in the UK actually. Our culture of talking about shares and stocks is far less developed, and almost verges on taboo. And if I think of people my age and my friends, it's not something that people are have a bit more scared to get involved and take that step in this country. So in that sense, I think it's great that there are podcasts like this to start giving people information and allowing people to build confidence to give it a go.
Yeah, that was actually one of the reasons we did it as well, because I actually listen to quite a lot of podcasts myself. I probably listen to maybe
Yes.
10 or 15 hours of podcasts a week. And
Mhm.
for the US ones, there's some really, really good podcasts. There's so many podcasts that you're just not going to have enough hours to listen to them all. But for the
Yes.
UK, I'm probably only aware of one podcast that I think is really, really good for the UK. And that was, do you listen to Investors Chronicle, the Alpha podcast they do once a week?
I've subscribed to it, but I don't listen to it, to be honest, because I'm like you. I listen to a lot of the US ones, and you sort of run out of time, don't you?
You do, yeah. But they do. I think they must be pumping out podcasts every like 2 or 3 days, but once a week they do one called the Alpha Podcast, and there's an analyst on there called Phil Oakley who's on it most weeks, and he's very, very good. So I would actually, if anyone's looking for a UK focused podcast other than ours, I would recommend that one actually.
Yeah.
He's got a book as well, but I've not read that.
Yes.
So if we go back to Tesla, which you mentioned your 85x returns on,
Yeah.
you just talk about what it's actually been like to hold a stock over such a long time period as it's gone up 85x, because there's so many people that they say, oh, well, of course, they'd maybe say, of course, you've got good returns. You've had an 85x on Tesla. But then, for using me as an example, there's no way I'd have held on to Tesla as an 85x. I would have sold it at some
Why
point
not?
along the way. That would be my conviction level with the company. There are some companies where I think I could hold on for an 85x, but Tesla just isn't one of them. But I'm just wondering what it's been like, because you might feel completely differently once it's up 85x, because you've said now it makes up over 20% of your portfolio. So what's that been like, and how do you feel about the allocation now?
It's been a very interesting journey. I mean, I'm very comfortable with it because for two reasons. Firstly, and foremost, I think it's earned its place to be there. So I didn't invest a disproportionate amount in relative to other positions. In fact, less than I would tend to now. And I actually, I'd say one of my biggest mistakes has been with Tesla, and I learned a lesson early on in that because it was quite early on in my active investing career. It ran up about 3 times. I was on 3x within about 7 or 8 months, and I panicked because I wasn't used to that kind of run up. So I sold probably about half my position. And then, if I look back, if I didn't sell that position, Tesla, I think I calculated it would probably be about 35 to 40%. So I don't even bother calculating what it would be worth if I didn't sell that initial position. And that was a bit of a lesson for me, to just let things run. So it hasn't been a straight line on Tesla. There was 4 or 5 years where things were quite tentative. There was a lot of they weren't making money. They sort of hardly are now, really. And Elon Musk was saying a load of crazy stuff that was getting him in trouble, and he was smoking dope on podcasts and stuff, and there was a lot of controversy. So it was pretty flat. It wasn't going anywhere for 4 or 5 years. But I guess in my mind I thought, okay, I sold that initial position. My initial outlay is gone from Tesla. So I consider what I've got left there as much lower risk. So that's been the key sort of journey, and I still believe in the story. I think 3 to 5 to 10 years. I don't know. I mean, obviously it's a huge market cap, but it is a leader in its space, and it's still got a huge amount of optionality. So why can't it be a 2 trillion company, a billion market cap company in say 10 years time, or 5 years time? It could be. The thing that freaks me out a bit about Tesla is that a 1.1% movement, either way, up or down, is equivalent. It's got to that point where 1.1% movement is equivalent to my original outlay. So it might go 3 or 4% down in a day. That's like 4 times my original outlay now. But I've sort of got past that mentally somehow. I haven't. There's only been once or twice when I've trimmed a little bit just to fund some other positions, but I'm going to just keep it and just let it run and see what happens. So I'm comfortable with it because it's earned it. The key thing is it's earned its position, and that's what's made me comfortable.
Okay,
Does that make sense?
Yeah, it does. Yeah. So as an example, like you wouldn't start with a 20% position in Tesla now if you didn't already hold it.
No, of course not. No, I would not do that. I wouldn't do that now. But I would hold what I have. I think any of my positions that are more than say 4 or 5%, I'd be less likely to be adding to any of those, to be honest. I'd be letting them form their own deserved allocation in my portfolio. But yeah, I don't spend a huge amount of time. I don't have a very sophisticated model. I spoke broadly about my allocation principles earlier, but I don't think obsessively about, well, I could be earning a much higher return if I cut Tesla in half, and then I could put that in more other. I don't know. I just like to hold. It's served me really well just to hold and not try and be too clever and not overthink it. So that's my strategy. And if I'm too overweighted, well, the way to compensate that is to invest in other parts of the portfolio so that they become a bigger part, like lower down in the portfolio, if you see what I mean.
Yeah. Have you read 100 Baggers by Chris Mayer?
No, I haven't. No. I've come across it in Twitter. A lot of people mention it.
It's a good book. It's quite an easy read as well, but you'd probably quite like that. And I think if you read it, you'd probably find that a lot of the things he's talking about you're actually doing without realizing anyway.
Okay.
But it'd probably complement your style of investing quite well, I think.
Okay. What do you think of that sort of style of leaving?
No, I agree with it. In terms of my own portfolio, I've got a few stocks myself where I wouldn't buy them at the current levels, but I don't. If I'm selling a business, I do think it should be because something about your underlying thesis has changed,
yes.
or if you need to access the money for whatever reason.
Of course.
I don't really like to sell on valuation because it's usually, Mercado Libre, that's one of my larger holdings. It's only an 8-bagger for me, unfortunately. But
okay, only.
it's at a level.
How disappointing for you.
Well, I see you with the 21, 22-bagger on it, and it just feels a bit inadequate. But
it is brilliant.
Yeah, so that's at a level now where I wouldn't be buying it now, probably.
No.
But then equally, we covered it a couple of months ago in comparisons to see. And the numbers it's putting up, they are just incredible numbers for a business that size. And as well, with Mercado Libre, it really has had a lot going against it in terms of like exchange rate movements and instability in the countries that it's operating in. So to put up those numbers, it really is incredible. So, I don't know, I think something I've maybe shifted towards, it's probably only in the last few months, really. It's from watching all the old Berkshire Hathaway meetings. But now I want most of the businesses I own to be businesses that to me are just obvious, if that makes sense. So there are some businesses where every now and then you come across it and it just makes total sense. So an example for me would be Etsy. It's just such an obviously brilliant business that I am comfortable holding that possibly at any valuation, really, as long as the business continues to perform. And I'd put, like, for example, looking at some of yours, I'd put Unilever and Facebook in that category. And I think when you're holding businesses that just have that higher level of conviction in, and they are such quality businesses, I think it's a lot easier to hold on to them, because if you're holding a business you have less conviction in and it goes up 10x, it could be very tempting to take that. And I'm ranting a bit now, but
no, I think I'm completely with you. It's sometimes it's just around holding on, quite frankly. Certainly when it becomes a bigger part, well, then it's a substantial part of your holding then. So there's no need, adding that really higher price. Of course, there can still be a run up, but you're better off investing lower down in your percentages, in my opinion. So I agree with you. Yeah.
I think the problem as well with selling based on valuation, it's a company. If you take a company like, let's use Peloton as an example, you could look at that and come to the conclusion it's overvalued.
Yes.
But when it's growing at such a fantastic rate, give it 2 or 3 years, it could easily grow into the current valuation. And if you're selling it, but you love the business and you think you're going to buy it back cheaper, you might never get that chance. because
Well,
it
exactly.
might
Yeah.
just stay at the current levels, or if the numbers carry on as they are, it's, overvalued businesses, they can stay like that for a long time, and then you look back a few years later and you think, well, actually, knowing what was going to happen, it wasn't that bad a valuation anyway.
Yeah, well, I mean, the risk is you never buy it because you're wait. That it's another area in which there's lots of rhetoric in investing, isn't it? Where, I'm waiting for that dip. I'm waiting for a dip. If you can be forever trying to time that, or trying to sell to buy again on a dip. I mean, I think that's so difficult. I just trying to avoid that. I've got no issue if I've got a very small position and I want to build it up over time. I've got no issue at all with buying at all-time high prices. I don't wait for a dip, because you don't know if and when that dip's ever going to come again.
So what would you, how do you start a position? Would you just say, I want 2% in, I'm just going to throw it all in now, or would you stagger it, or how do you think about that?
I mean, I would tend to stagger it. I mean, I'm at the position now where, to be honest, any new entry position, it's quite hard to get to start with a even a 1% position, quite frankly. But in terms of absolute amounts, I've always been quite consistent in terms of how much I might trickle in a month or whatever. So I'll start with that initial absolute amount, and I'll look to build that over time. Now, depending on those three categorizations, so I think it's the kind of ballast. That's a terrible word, but it's the best one that I've found. The kind of ballast stocks, the Unilevers, the Fangs, the growth stocks, and the moonshots. I will look to build for a new position. I'll look to build a much bigger position in, maybe try and get to 1 or 2% for a kind of foundation stock, maybe a 1% for a growth stock, and then for a moonshot, it'll be tiny. It'll be like 1/4% of the portfolio, and then if it comes off, then I'll start adding a bit more. But yeah, there's once in a while I'll go for it a little bit, So I think Peloton is probably the biggest example last year, where towards the end of last year I thought, yeah, I'm going to go for this one, and then I'll put in, I think I put in, say, 1.5%, which was quite substantial to start with. But in general, it'll be 1/4 to 1%, and I'll sort of build up as the story builds, essentially. Yeah.
Okay. What do you think about, and I saw you actually talking to someone about this on Twitter recently, but what do you think of diversification and how it can impact returns? So you've got the issue on the one hand where if you've got too many stocks, you can become an index fund, and then if you're too concentrated, whilst it works well on the way up, it can also work quite badly on the way down. So it's balancing that, and as well, your top 10 stocks make up 62% of your portfolio, but you've got 60 stocks in total. So I was just wondering what your thoughts are on diversification versus concentration.
Yeah, well, I think you diversify to the extent that you're comfortable, and there's no right or wrong answer, and everyone's got their unique DNA in terms of how many positions they own. So I like having a lot of positions. It gives me security and comfort, and at the end of the day, I am concentrated in those kind of key secular trend kind of areas, the e-com, advertising. My portfolio doesn't mimic the market in any way. I've got no oil or natural resources, a minimum amount of healthcare, no banks, no supermarkets. So I'm missing out on some huge areas, arguably safe, cash generative, but not growth areas. So I probably would like to bring that level down, but a lot of those positions at the tail end are quite experimental and moonshotty, if that's a verb. So I'm looking to see how they play out. The reason I've got so many is that I'm sort of investing or betting on them being the potential Mercado Libres of the future. So I don't feel it hasn't held me back. I was still able to get a 101% return next year, even with 55, 60 positions. Of course, I could have doubled down and put it all in Tesla. And I think Tesla went up, what was it, 5 or 6x last year, and made a mint. But I wouldn't have been comfortable with that, and it wouldn't have been fun, because it's not just about, and I think it's the same for you, Sam. Tell me if I'm wrong. It's this a hobby as well, you know.
Yeah, it definitely is.
It's not just about wealth building. It's a hobby. I enjoy it. It's like a side hustle. It's like, you know, people are into sport. People are into playing golf. This is you know, one of my equivalents. So yes, if you're over diversified in terms of segments, I can get how it can mimic fun, but if you've got some themes and some strategies within it, you can comfortably outperform. I think, have you come across this concept of the Gardner-Kretzmann continuum?
I have, yeah. No,
I don't know if you've covered that in your podcast.
We haven't, so do you want to just explain what it is?
It's David Gardner, who I'm a very big fan of. So he's one of the co-founders of the Motley Fool, who I know you've spoken about before. And David Kretzmann's one of the writers or the analysts. And they came up with this score, which is basically to say, if you look at the number of stocks you own and you divide them by your age, you get a score, which is the Gardner-Kretzmann's, your own personal Gardner-Kretzmann score. So for example, if you're 25 years old and you own 50 stocks, your score would be 2, for example. And they kind of say, if you want to be balanced relative to your age in terms of risk, reward, you should try and aim for around 1. If you've got more than 1, if your score's higher than 1, then you're possibly a bit over diversified. If you're less, then you might have under diversified, a bit more risk. So I think that's quite a nice guide. I'm about 1.2 on that dimension, and I'm sort of happy to be at that sort of level. Do you know what level you would be at, Sam, for that?
Probably at about 0.6, actually.
You're bold.
Well, it's not.
That's good. No, but that again is that's your own special sauce and DNA, right? In how you do it, and that's perfectly fine as well.
Yeah, I mean, to be honest, there's 30 or 40 companies I could come up with a list where I'd love to own them. It's just getting them at the right moment. So I guess where the moment's been there, I've only ended up going in on a few of them, and luckily they've done very well for me so far. But
yeah,
there are a number of companies. It's certainly not a deliberate thing. And if we got another March like event and I had the cash available, there's a number of companies or March 2020 like event and I had the cash available, there's a number of companies where I'd love to just pile into those.
Yeah. What would be, do you have a clear view of where you would start on that in terms of what you would get into, 3 or 4 ones that you don't own but would be higher on your watch list? Or was that too?
No, so Match Group would be one, actually.
Oh yeah.
I think that's
I've got Match, yeah.
A really impressive business.
Yeah.
Peloton probably would actually be another. C Limited, that'd be probably a third. I'll see if I can think of a fourth.
Very good.
There will be a fourth. I'm just trying to think.
Yeah, I'm sure. Well, they're 3 very, very good ones that I've owned for a few years. So yeah, no, very good.
But then there's a few where I feel like now there's some really good. They're probably not likely to generate the same sorts of returns. But I think whilst we have talked about US valuations being so high, there's some of the larger US companies, the valuations seem quite low in comparison. So like when you look at Facebook, a PE of 28 and it's still growing revenue at 30% a year. And even companies like Disney, where it's probably at a normalized PE of about 30. But then if you look at what Disney Plus could actually be, and it's already got 80 million subscribers, that seems incredibly cheap. So those are probably 2. I guess those are 2 that I'd probably be more likely to initiate a position in sooner rather than later, because I do think they're at such attractive levels. So yeah. I guess if you follow enough stocks for long enough, you will get your chance with all of them at some point.
No, absolutely. Yeah. Well, all great examples. And I agree. Some of those, they almost in context, they feel slightly undervalued, don't they? The Facebook certainly, even Amazon with their results last week, Disney for sure. You can see quite a bit of room to grow in what are considered very solid, stable stocks, right?
Yeah. So you've hinted at it a bit with the Gardner-Kretzmann continuum, but what resources do you use for investing and finding stocks, and they can be free or paid. They could be audio or websites, whatever you want.
Sure. So yeah, I mean, Motley Fool are certainly a kind of service that I have taken advantage of. So I have been a member of some of their paid services, like which again I think you've mentioned before as well, Stock Advisor and Rule Breakers as well. Rule Breakers is probably the most attractive one, and which gave me the confidence to invest in some of the more the Mercado Libres and even Tesla. A lot of the insight on Tesla I would have got from Motley Fool. They've also, and again, I think you've mentioned some great podcasts that they have as well. So Motley Fool Money, Market Foolery, Rule Breaker Investing. You just learn a lot, and there's a lot of insight in companies and in terms of the coverage. There's another service called 7 Investing, which I don't know if you've come across that one.
I have, yeah. No, I followed. I think I followed most of their analysts when they were still at the Fool, actually. So
yeah, which is also very, very good. I mean, they go even deeper than the Motley Fool in terms of analysis, and a lot of great, great podcast as well. Too much content to consume, quite frankly. Over and above that, then some of the apps for getting kind of a broader suite of articles and information and technical information. I really enjoy Yahoo Finance. Tip Ranks, I think, is good for going a bit deeper on fundamentals. And then I like reading a lot of magazines just for business insights. So Fortune magazine, I get a lot of good ideas and insights from there. But I try and kind of join dots and triangulate across many sources and obviously go to the company in question's website and build a point of view. And then more recently, especially in the second half of last year and during lockdown, Twitter's been a big source as well. So I only set up my kind of investing account in the second half of last year, and it's incredible what you can. There's a lot you have to be careful, and I'm sure you found this. There's a lot of chest beating and a lot of bluster, and there's a lot of traders on there, but you can learn a lot. People do some great analyses, and I've also made a few friends on there, especially some UK based guys as well. So it's good. I think I've seen your TED talk, Sam, where you talk about having friends to talk to, and having to bounce ideas off. And there's a number of Brit investors like-minded, and it's been great. I've never met these people or anything, but we're quite like-minded, and you sort of bounce things off each other, and you share each other's progress. And it's this is going to sound strange, but it's almost, especially during lockdown, it's almost been a good thing for my mental health as much as anything, because it's given another outlet for connection and for camaraderie, to connect with some people on Twitter. So those are the sort of mix of sources I get. I don't read. I know you're a very avid reader. I don't read a lot. I've got children, and I that kind of means I don't have a lot of time, but I am finishing reading The Psychology of Money, which is by Morgan Housel, which is really, really good.
Yeah, I enjoyed that one.
Yeah, it's great. But yeah, those would be my main sources, I would say.
What are some of the best accounts then that you'd recommend following on Twitter?
Well, there are a lot of good ones, and they're easy to find. The one source to find people to follow. Have you heard of this? It's an account called invertir.blog. Have you heard of that?
No, I haven't.
What it is, it's really interesting. Well, this person has set up basically a portfolio. What he does, he gets the top. If you go to his profile, invertir.blog, there's a link, and on that link, what he's done, he kind of sources the most followed financial Twitter people who are followed on Twitter, and he's built a portfolio of their top 25 positions across that. And there's a lot of overlap, as you might imagine, and he measures the progress of that versus the S&P, and it's quite fascinating actually to see the overlap. So if you go on there, you can see some of the big names that have got big followings, who are well known. I think you've spoken about some of them, like Puru Saxena, for example. So, you know, for in terms of investors, I'd recommend going to that and then playing around and seeing which kind of fit your style. I think there are some other guys. Brian Feroldi, have you come across him?
He's fantastic,
yeah. Who just gives loads of really good insights. Beth Kindig.
She's very good as well.
She's
I'm
very
probably
good.
going to say this about all of them, but
yeah, but then the other thing that given that this is a kind of a British podcast, you know, I would shout out to some of the British and Irish brigade that's there as well, and people that I've, you know, built good little Twitter friendships with. So a guy called Arsalan, a guy called Professor 95 of Data Science. There's Adventures in Financial Independence. If you went to there's a Portuguese guy called Duarte, who's brilliant. He does these really succinct one-page summaries of a kind of strategic rationale for buying stocks. That is just brilliant. So I've got very aligned kind of thinking with him. So if you were to go to my profile, you'd see some of these guys that I follow. But I like this kind of British brigade. We're kind of a little mini sort of friendship circle. They might not think so.
You follow Investment Talk?
What's that? Sorry.
There's a guy called him. There's a Scottish
Investment
guy.
Talk.
Yes, with 2Ks.
With 2Ks. Yes,
yeah.
yes. That's another one. Yes, and then Irish Born Investor, who's quite entertaining as well. So yeah, you can build connections. You learn different approaches, and it's entertainment, I think, as well. But you have to be careful as well, not, you know, to make your own decisions and not to get sucked in by it too much.
I think I'll probably, once this is done, I'll probably actually have to go down your follow list and see which ones I'm not following.
Do you use it a lot yourself, or?
I do, yeah. I use it quite a lot now. I just think it's brilliant. Like you say, some of the stuff you can get on there and that they're putting out for free. I think when you've been on there a while and you've refined who you're following, I think it's unbelievably useful. But I think the issue is, like you say, just making sure you follow the right people. But I'd happily,
no, exactly.
I'd probably happily pay quite a lot a month just to subscribe to my own.
Yeah, no, I agree.
If Twitter started charging, I probably would pay for it.
Yeah, no, I agree. I mean, in fact, there's this guy called Chris Camillo. Have you come across him?
I haven't, no.
So he has a YouTube channel as well called Dumb Money. But this guy has made a career and a mint from. He picks up all of his insight on stocks and secular trends and what the hot new investments are going to be purely from social listening. So he's built actually a tech platform that I think he's sort of sold it, but he uses it fundamentally to develop his theses in terms of what brands and what businesses is there a lot of noise in social media around, and he's got kind of some algorithms that feed his investment choices, and he's been incredibly successful. If you look some of the money he's made, that's the gains. It's like different planet. So it's very interesting in terms of the insights on trends that you get from it.
What do you wish that you knew when you started investing that you know now? So, like, what advice would you give yourself when you were starting out?
Well, the key things I would tell myself, firstly, just to start earlier, to take those first steps and not be shy. And I'm very envious of you with your age, because you've just got such a long runway. But I've got some nephews who are quite fresh out of university, and they're starting their journey, and they're sort of 23, 24. One's really into crypto, the other one's getting into sort of shares, and it's brilliant because they'll learn. And I just wish I'd started earlier. And that's something that I'm trying to institute into my children as well, actually. So from the age of 6, when it's their birthday, I ask them to choose a company they like, and then I buy it for them in their junior ISA, and I'm just going to leave it till they're 18. So I sort of want to educate them as well, and they've made some good picks actually.
How old are they now?
They're like 7, 9, and 11, and it's companies it's things that they use. But one of my children has got Roku, because we have Roku system, and they're four times on Roku. To
get them on the podcast.
Yeah, I know. They've got Disney, they've got Zoom, because all their lessons starting with Zoom and all the rest of it. Apple, so Netflix. I mean, the first purchase was Netflix for my oldest, and that's 6 times since he chose that 5 or 6 years ago. So yeah, I think that would be the first thing. Start earlier, and then the second thing, and we've mentioned it, is if you really believe in a business and its future, don't fret too much about valuation, just to take that starter position. So that would be, because otherwise you'll always be waiting, so that was definitely, like, companies like Apple and Amazon, I could and should have been in there way before I was. And that, in a way, that was a platform to start earlier on Tesla, given the learning that I had on some of those businesses.
I think looking back on mistakes and stuff, and I think what's frustrating, it's easy to look back and say, oh, well, I should have bought this when it was this price. But I think when it really is a mistake is when it's something where it's similar to what you're already doing, and it's within your ability to understand it, if that makes sense. Because there's some stuff where, like, someone could do well on a pharmaceutical stock, and I'm not going to think, well, I should have known that, because I don't have the toolkit to analyze pharmaceutical companies and the product line and stuff. But then something like a Peloton, if I'd looked at it a bit less cynically at the start, I probably would have realized. So that's something where it's a mistake, whereas a pharmaceutical company just wouldn't be in the same bucket.
Yes, well, I think that's right, especially if you understand the company, and if it's the sort of company or brand that actually you use every day. Some of the businesses that have done so well, the Netflix, the Amazons, the Apples, the Facebooks, in retrospect, they're companies and brands that have just infiltrated our everyday lives. We use them on a daily basis. So sometimes it's just not about not overthinking it, really, and being able to see ahead.
What are the biggest mistakes that you've made then in investing?
To be honest, I think I've mentioned them. I think the biggest one was probably Tesla. Is my biggest success. So selling a big portion too early on. Even Unilever, which is my number 2, I sold quite a bit early on, and I wish I didn't. So it's mainly been around selling too early. There are some companies I've held on to too long. Some of the British companies that I used to hold, like Burberry, for example, I held for many years, and I don't own it now. I just sort of lost. Eventually, you have to, it doesn't happen often, but I lose patience and I'll exit, and I'll probably let that one run a bit too long.
When you say lose patience, is that based on what the share price is doing or what the business is doing?
A little bit of both. In that example, you kind of believe in the brand. It's great management, great international expansion at the time, but then the things in the long term, the things go hand in hand, right? So if the company's not executing consistently enough, then it just, from a share price point of view, it does start to get, you lose a bit of belief. And I still made a gain on Burberry, but I had a decent sized position, and I held it too long, and it just didn't. It didn't feel good. I wasn't satisfied with holding it anymore, shall I say? Yeah. And I don't know how it's doing now. I don't know if it's one you've looked at.
We have actually. We quite liked it, but we've only looked at it recently.
Right. Yeah. No, I had it for about 7 years or so. Yeah, I had it for 7 years or so, but maybe it was up and down, and I don't know, my gain and exit in the end, maybe I was up 20-30%. I don't know. But yeah, was your conclusion that that's a good one going
more
forward?
Of a value,
right?
But it just looked quite reasonable for what you say. Is like, it is a high quality business, and then you've got in this. We've only actually looked at it since COVID, so it's still down about a third off from where it was. So it's more if the international travel comes back.
Yeah.
It's just getting back to where it was. That's what we quite liked about it.
Sure.
As to whether we'd feel the same once we're back into a normal situation, I don't know, but it looked quite reasonable when we looked at it a few months ago. But I think you've already hinted at this a bit, but what are your thoughts on rebalancing?
Yeah, I think it's important, but I'm not over obsessed with it. So I aim for this kind of 50, 45, 5, as I said, kind of solid growth and then moonshot. I'm probably at the moment I'm not in that at all. I'm probably more like 40, 55 or 57, 3 or something like that. So what that will cause me to do is build up. I'll rebalance through adding where I feel I'm a bit over. So I'm probably, even though I'm growth oriented, I do like dividends as well.
Mm.
Unilever has taught me that, having held that for so long. So I'm building up a few more sort of dividend positions at the moment. So I'll probably just do it that way, but and balance over time through what I contribute. That's how I'll do it, not by reallocation.
What are your
Yeah.
thoughts on adding to existing positions in terms of adding to winners and adding to losers?
Yeah, I'm a big fan of adding on the way up and adding to winners. So I've got a much bigger tendency to do that than adding to losers. I think if it's a company that I really, it depends what you mean. What's your time frame for losers? You can have something that's not an all-time high, it might be 20% off its high. But if I still believe in it, I will buy. But by definition, I don't think I've got any losers, because if it's a loser, it shouldn't be in my portfolio. Does that make sense?
It
So it
does,
might
yeah.
be, it might, like Zoom is a good example. That's a bit, that's been my luckiest purchase, I would say, because I bought that in January last year, and that was, before the pandemic and everything moved to Zoom. But now it's kind of, so I've had a really nice return on that. It's in my top 10, but it's quite depressed. Now, would I add to it now? Yeah, I probably would, actually, even though but I don't see it as a loser, because I think that one will still be a long-term winner. Yeah, so I've got almost like a philosophical issue with that question, because if it's a losing company, if it's a cheap price, or it's depressed, then I would add to it. I've got no issue, because I still believe in the long-term story.
Okay. What about if loser is redefined to only include stocks where you've bought it and they've gone down, so you don't have any gains on it yet? Would that change it at all?
Yeah, I would buy, and there's certainly some positions where I've bought at a high price and it's come down, but I still carry on building. So, Pinterest, which obviously had the great results, I bought, and then it sort of came down a fair bit, and I bought more. Teladoc would be another one. But my thesis on why I own the stock doesn't change. So I've got no issue with buying on if it's a slightly depressed price. In fact, that's attractive, right? So I'll do it both ways.
So what I'd like to do now is just go through some of the stocks that you've got in your portfolio, and I've just got a few questions about them, if that's
Yeah.
all right.
Okay.
So the first one that I picked out was Unilever. So it's the only UK listed stock in your top 10. So what do you actually, why is that, and what do you like about it?
Yeah, I mean, it's as I touched on earlier, it's a bit of a cheat, because I started there, and it's the longest held. I've had it for over 20 years, so I've learned a lot from it. I mean, it's the ultimate lesson in compounding, and it's the stock that's made me love dividends. So, I mean, the yield I get now, 20 years later, if I look at that as a yield on my original investment, it's over 20%. Of my original investment that I get every year, and it just the way I've seen that grown every year has been fantastic. So I mean, it's the only UK listed stock, because it's the only one that's had the time to grow to get there. I'd love to have more UK stocks in my top 10. But unfortunately, at the moment, the US stocks a faster pace growth. The other one that I'm aiming to get into my top 10 over time would be Diageo, and it's not far off. It's probably about between 15 and 20th in scale, but that would be another one that I've got very long-term sort of conviction in, earns a decent dividend, although I got it at quite a depressed price last year, so it'll end up being a decent dividend. So I would like to, I think, I see them as quite similar, global, great brands,
Definitely.
great marketing machines. They ain't going anywhere. So yeah, that, Unilever, I mean, it's got one of the best kind of marketing capabilities globally, and one of the best stable of brands. The only worry I do have about Unilever, I would say, is it's the way it's keeping its growth trajectory. I mean, clearly it's got a dependence on emerging markets, but over time it's slimming its portfolio. Where, you think about, there was the spreads business. I think they've announced they're going to get rid of their tea business, so they're sort of becoming a more constrained kind of business in terms of the number of categories they operate in. Now, that's a good thing because they want to focus on the growth categories, but it's I don't know, I wouldn't be surprised to see a split of the food and the personal care and products business at some stage. I don't know. Yeah, I don't know. I know they're doing some M&A, which is good as well, but I don't know. I'm not 100% convinced by their product portfolio strategy. I think if you're going to sell, you define the tea category, you're going to sell it. Have you given up? That is, it smacks a bit of, well, we've given up on tea now, so we're going to just hive it. We're going to sell it off to private equity.
I don't really know much about their tea business, but I do know with the spreads that spreads is a declining market. So it actually, the whole market gets a bit smaller every year. So I don't know if that was one of the reasons why. Because even if I guess with a business like that, you could do everything right and maintain your market share and potentially even grow it. But if you are in a declining market, you're swimming against the tide, aren't you? Maybe
you are. Well, I mean, yes to no. I would say the other point of view would be, you're not doing as a category leader, you're not doing a strong enough job to keep the market modern, relevant. You can impact the market through, if you take the tea market, one of the biggest global beverages in the world. It's how do you look at what Starbucks did in the coffee market, right? I mean, when Starbucks came to the UK, and the idea of paying £3 for a cup of coffee was ludicrous, and now it's like we take it for granted. So it's also in how you, as a brand leader, reinvent and modernize and keep the category relevant. I know spreads is probably a harder one because there are big kind of health trends and all the rest of it and how people consume, but it's not just about market, it's about your impact in the market as well. I think might be a bit unfair.
No, that's interesting. Starbucks is an interesting example, actually, because my statistic, I think it's something Warren Buffett was talking about last week. I listened to the 2006 Berkshire meeting, and one of the things he was asked a question on Coke, but he talked about how at that time, and this is obviously from 2006, but the US if you looked at the US consumption of liquids, Coke was gaining market share every year, and coffee was actually declining. The US people in the US, they were drinking less coffee every year, and its market share of beverages, I guess, was declining.
Yes.
But Starbucks, despite that trend, did unbelievably well in that time period. So I do get what you're saying.
Yeah, I love Starbucks. I'm a very happy that again, that's one of those that obviously they've had some headwinds in the last year, but I can't see that I can't see that I'd want to sell Starbucks ever, sort of thing. And it's a sort of product I'll use a couple of times a week. It's just one of those solid global players, lots of growth in China and all the rest of it. It's brilliant business.
So the next one I wanted to talk about was Lemonade. So that's, for anyone who doesn't know, it's a US insurer that's doing the rounds. People on Twitter seem to like it a lot. So I've not looked at it in any great detail, but I guess it's because of the industry it's in. So my issue with an insurance business is it's very, very difficult to value, because you could be growing as an insurance business, but you could be doing that by writing insurance at prices that will turn out to be unprofitable. And it's very hard to differentiate good growth from bad growth, I guess. So how do you think about that, and what do you think of Lemonade?
Yeah, I mean, I'm no expert on the economics of insurance, but the reason that I am a big fan of Lemonade, and Lemonade I would characterize in the moonshot part of my portfolio, right? So it's high risk, who knows, but it's a company and a brand that is trying to disrupt a very old school model. If you look at traditional insurance, it's based on a bit of an adversarial relationship between company and client. You know, providers of insurance, their goal is to try and minimize payouts to customers to maximize their profits. So there's an incentive to deny claims. So the way, you know, Lemonade is looking at a very, you know, they're trying to reinvent that. And so they're doing so many innovative things. So number one, they're trying to create complete transparency on their business model. So the way they work is when you buy a policy with Lemonade, they keep a flat fee, 25%, and they use the rest on reinsurance and to pay claims. So they'll pay the claims from the reinsurance and from the flat fee. But then what they do is any unclaimed premiums they give to charity. So and as when you buy insurance, if you don't claim, then there's a portion of your premium that you can actually choose what charity to pay it to. So that's a very different approach, with, you know, built on transparency, the use of technology. So they're using AI in the user experience. So it's a very, very, you know, I mean, buying insurance can be such a pain, and what they're trying to do is simplify it. So I think there's some statistics that both in getting a policy and in getting a claim, I think the record they've done is 3 seconds, where someone got their coat stolen and they got their claim paid in 3 seconds. So it's very tech-based approach, and they're just kind of challenging the conventions of that industry. They're a B Corp, so a public benefit corp. So they're massive appeal to kind of millennial, younger consumer audience, and they're very light on fixed costs and staff. So it was quite interesting. It's worth looking at this as a story, but I think they've got about 200 employees, this company, and the US largest insurance company is called State Farm. They've got 48,000 agents. Now, because of their AI model that they use to write policies and manage the customer experience, I mean, that's a massive, huge cost that they're avoiding. And, you know, actually a couple of years ago, and it's worth seeing this on YouTube or what have you, or some of the articles, they ran an attack ad against Lemonade to kind of criticize that it wasn't a real person behind it, and then it's all AI, and do you want to deal with an AI kind of bot or whatever. But this, you know, it actually, Lemonade were brilliant in terms of how they reacted. They says, okay, State Farm, so you forked out millions of your customers' premiums to attack Lemonade. Yeah, and yeah. They've got all these sort of and Lemonade actually used the State Farm ad in they used it to kind of push their own proposition, and I think they got to 1 million. They were one of the first. They got to 1 million policyholders in a kind of record time. So I think, you know, who knows? I love the fact that they're just looking at that business model, looking at the consumer pain points, and they're just trying to reinvent the whole thing. And they seem to be getting traction. Their NPS score, you know, Net Promoter Score, the average, you know, the highest an average US insurer gets is 20 as a Net Promoter Score, right? Lemonade's Net Promoter Score is 70. So they've got a lot of love. So they've got something going there. And I think they're very early. They only sell pet insurance, rental. There's a lot of segments. There's a lot. They're only in the US, a bit in France. It's very, very overvalued. It's hugely overvalued. There's a lot of hype about it. It might not work, but it could be one of these that could be a big winner, I think. Does that make sense? I went on about that.
It's a really good explanation. Yeah. So the next one I want to talk about was Jumia. So Jumia is actually it's the kind of company that I do like, in that it's obviously been described as the Amazon of Africa. Which as an owner of Mercado Libre is something that I did take a look at it when it first IPO'd, and I have followed it ever since, really. It is a stock I looked at in a fair bit of detail, but I had the first issue I had was they were losing an unbelievable amount of money compared to the revenue. It was actually impressive how much money they were able to lose. The other issue I had was delivery and infrastructure issues. So because of the way Africa is as a continent, it doesn't have the same level of infrastructure that we have in Europe or America or even in Latin America that you take for granted for a business like that. So what it meant was that the biggest problem was it was what's called last mile delivery, wasn't it? Where,
Yes.
I mean, a lot of people, they didn't even have postcodes. So that can make it incredibly difficult to actually get the stuff to them. I've seen people talking a bit more about how it's now moved to more third-party selling, which is a lot more profitable.
Yes.
I don't know if that's coincided with it's doing a lot better as a stock. Actually, I think the market cap,
Yes.
it must have dropped to about 200 million or maybe even less than that. It's at 3 or 4 billion last time I looked at it.
It's 5.7 now. Yeah.
So point through. But
Yeah.
I remember I think the Jumia Pay aspect looked really interesting
Yeah.
as well. So do you want to just talk a bit about why you own it and why you like it and how they've overcome those problems that I described? Or how they seem to be?
No, absolutely. So again, Jumia technology fits within that moonshot. It's one where there's a high level of uncertainty, and it's not about the economics as they are now. It's all about the future. Yes, they are loss making, and you're right. A lot of the delivery issues, infrastructure issues are probably more tough in Africa than they are in any other continent. But those issues and challenges are exactly why I love it in a way, because they're trying to carve a position and a leadership position in a really, really tough market with lots of barriers. So, and there's the two guys who own them who are well versed in e-com. I think they're ex-McKinsey guys, but they're learning. They're bit by bit, they're learning, they're growing, they're finding ways around. The level of misdeliveries is going down, and they're starting to build a bit of credibility and scale. I mean, it's going to be years until they are profitable, in my opinion, but they've got a decent amount of backing, and they're adapting as they learn. As you say, they're becoming more of a third-party vendor. They've started partnering with big global players as a route to market for them. So they sell a lot of P&G products and Reckitt Benckiser products, for example. And slowly, they're sort of getting it done. So you need to, for me, the thesis on Jumia is around can they overcome a very, very challenging, can they crack it in a very, very challenging set of economies and conditions would be the first thing. But the key thing is, for me, is the other side of the equation, which is the potential. So yeah, I mean, I bought it. It was 3 billion market cap, so it's 5.7 now. So I'm about 80% up. But if you look at it as a percentage of Amazon, and that's a stupid comparison, right? Because Amazon's 1.7 trillion nearly. But even Mercado Libre. So if we take Mercado Libre, that's 93 billion, right? So it's 6% of the market cap of Mercado Libre. It's clearly very early in its evolution. But even if it becomes hard, say they overcome some of these issues and get to a sustainable delivery model, even if it becomes half the size of Mercado Libre in say 5 or 10 years time, then that will be a 15 bagger just there, and if you look at the sheer market, the addressable market that it's, Africa, it's like South America, where Mercado Libre, there's about 400 million population. Africa, 1.2 billion. So Nigeria alone, 200 million population. It's going to be it's forecast to be the third biggest population by 2050. So if they're able to make it work, they're also offering Jumia Prime, right? So they're copy pasting Amazon, right? Prime delivery. Even you get free viewership of Iroko TV, which is kind of a Nollywood, this is in Nigeria, Nigerian kind of Netflix, if you like. If they can crack it on the delivery and the payment side, then I think, my God, even if it gets to say 15 billion, so a small portion, a tiny portion of a small portion relatively of, then I'll be very happy. It'll be a really good return. So that's my thesis there. There's a lot of risks, but I think it's worth a go. And if it doesn't come off, then I haven't, because it's in my moonshot part of my portfolio. I'm willing to take that risk. Are you sold? Go on, Sam. Yeah,
I need to be careful of Jumia because it's a kind of company I'm aware I'm just so predisposed to liking. I think I did actually have quite a serious look at it when the market cap was about 400 million.
400 million, my goodness, you'd have done very well if you, I wish you'd told me then, because you'd be on like a 12 or 13 bagger then.
It was at that point where it just seemed to go down every day as well. And it was getting my thesis at that point, because they hadn't started the third party selling, so there was a danger of them actually, I think, running out of cash really. But they were. What I liked about it was my thesis was if it got to a certain point, Jumia Pay alone would be worth taking on the risk of all the rest of it, because Jumia Pay, for anyone who doesn't know, that's basically like the PayPal of Africa. They're trying to turn it into. But no, I do like what they're doing as a business, and it's an interesting one where I'm quite happy following it, and I don't mind paying. I wouldn't mind buying in at, say, a 10 billion market cap instead of 5, if it looks like they've overcoming a lot of the issues that I was concerned about. So it's one I'm definitely following.
It's on your watch list. It's on your watch list.
But I go through them. I go through my watch list like once a month, and I've just got a spreadsheet of it, and I'll go through it, and I'll just see what the price has done in the past month, and then I'll just mark whether I think it's like expensive or cheap or like fairly valued. And I think every single month since Jumia has been on it, which is pretty much since it IPO'd, and that's the valuation. I think it started at maybe like 3 billion, then went down to about 200 million. Now it's up to 5 billion. Every single month it's been marked as overvalued. So
well, I think that's a bit of concern, because it might just stay like that, the nature of that sort of business,
Yeah. I mean, initially it was more overvalued in the sense that this business could go bust in the next 18 months or 2 years.
And it's still.
Whereas now it's like they're starting to turn it around, and they are starting to deliver a bit more. And I'd much rather pay for that kind of overvaluation.
Yes, no, absolutely. I mean, who knows? It's gonna. I mean, I'm expecting a very, very volatile ride on that one. But I'm prepared for that, because, as I said, it's in that part of the portfolio where I'm more sort of playing in a way. Not playing. That's not giving it respect, because it's a serious company. But where I'm willing to accept more volatility.
Okay, so the other stock I wanted to ask you about in your portfolio was Disney. So in December it was in your top 10, and now it seems to have dropped out. So it's a stock that me and John both really like, as I mentioned earlier. So I was just wondering, firstly, why you like it and why you hold or held it, and why it's dropped out. Has it dropped out because you sold it, or just because something else has risen enough that that's now in the top 10 instead?
It's the latter. I mean, I'll never sell Disney. I just absolutely. I mean, I was talking earlier about emotional pull. I think Disney's the ultimate for that. How can you not love Disney? It's an absolutely awesome company. It only dropped out of the top 10 because some of the players overtook it. There's a lot. I've probably got about 6 or 7 businesses competing for that top 10 slot, to be honest. So no, I haven't trimmed it, and I wouldn't dare do so. I mean, actually, it's one of the bigger adding. It is one of the businesses I would consider adding to, because I mean, if you look at the Bob Iger era, I mean, he just played an absolute blinder, didn't he? I mean,
it's unbelievable.
He
left at the perfect moment.
Oh yeah, that's a way to exit, isn't it? The most attractive entertainment properties globally, not just globally, but probably in history as well. Lucasfilm, Pixar, Marvel. It's a genius, and I just love what they've done with Disney Plus. What a pivot! What a leverage of their content. I mean, they've got new addition to Disney Plus in a couple of weeks. Star, have you seen that?
Yeah, I've got it. I'm a subscriber, so I get the emails telling me it's coming.
Yeah. Which is going to add a whole load of other content. So I absolutely love it. I think Disney Plus has got a huge runway ahead. I love how they're making the original content on, all the Mandalorian, all the Marvel. What's the one at the moment? WandaVision on Marvel at the moment. So there's just so much optionality, both from a content, and it's not even rolled out globally yet. And you think of the bounce back they're going to have with their parks business, which I know is a big profit contributor as well. So I think
it's like 40% of revenue. Parks.
Well, exactly.
I mean, those are pre-Disney Plus statistics. So
yes, no, absolutely. So for them, thank goodness for Disney Plus. I guess they've been a bit more stuck there. But when things get to a degree of normality, they're just going to go from strength to strength. So I think it's one of the best it's certainly one of my favorite positions and one of my favorite companies in the world. Is that how you? I sense you're a massive fan as well, right?
It's an unbelievable business. I think I said it a few times on the show already, but I think if you were to look at that and take Disney Plus out, it's probably trading at about 30 times normalized earnings, and I think that is pricey. But when it's possibly, you could make the argument that it's worth paying 30 times earnings for Disney on its own without Disney Plus. So then when you throw that in, and even if you just start playing around with the numbers, so like 80 million subscribers now, that's targeting over 200 million by 2024. If you just play around with, well, what if they get, $10 a month for each one? How much revenue is that going to add? How much are they going to have to spend on content? Because I don't think they need to spend that much on content because they've got such high quality brands. If they do 2 or 3 Star Wars shows a year, I'll pay full year round. It doesn't matter if they don't do anything else. So I think because of that, they don't need to be pumping out new stuff every day like Netflix does. Yeah. And if you you can just start playing around with the numbers. And even if you're quite conservative, I think you can easily get to a scenario where earnings in a few years are 50 to 100% larger than they are right now. And they're arguably more attractive earnings as well because they're so low cost. And I just think it's an unbelievably good business.
No, I'm with you. I love it.
Have you watched Imagineering?
Imagineering? No.
Oh, so it's
what
on
channel
Disney,
is that on?
It's Disney Plus. It's
okay.
So it's basically just like they've only done one series. It's like a 6-part. It just takes you through the history of Disney and the parks and how they build it and how they actually do it on a day-to-day basis and run it. And it's really, really interesting. And like if you just look, like it shows you what they're doing with like the animatronics and stuff like that. And and how they built the business with like even the cruise ships and stuff. Like you'll watch it and you'll think, oh, I'd love to. Like it's definitely worth watching if you're a Disney shareholder. It's probably something you could actually watch with your kids as well because they'd probably be quite interested to see how it works. But it's only 6 parts, but it's definitely worth watching, I'd say.
Excellent. Well, it increased your conviction even more, right?
Exactly. We've now run out of questions from me and John, so
That's
just got a few listener questions, if that's all right.
Sure.
In fact, we've covered a couple of them in conversation anyway. So one of them is Bitcoin, yay or nay?
Well, I'm not going to say yeah or nay. I'll say may. Sort of in between. So I don't own any Bitcoin. I might in the future at a small position. If I'm honest with you, I'm not a big fan, mainly because I don't fully get it. I don't understand it well enough. So I think if you look at it, originally conceived as a technological innovation, blockchain and that kind of thing, but it's kind of evolved to a store of value, and I can't understand the model of it, right? It doesn't make anything. So it's probably partly a function of my age, and I'm probably a bit old school from that point of view. But the fact that it doesn't produce anything, it doesn't produce profits. It's like a store. It's like owning a commodity, which I'm not really attracted by owning commodities. And the other things that would probably put me off is it's so responsive to sentiment and noise, right? So I think there's one of the not Bitcoin, but one of the cryptos, Dogecoin.
Dogecoin.
You heard of that one? Doge. I see. I can't even pronounce it. That's embarrassing. Elon Musk will tweet on it and it will go up 40% or whatever overnight. So there's just something about that just doesn't fit with my investing philosophy. And also there's a bit of a Scrooge in me that doesn't like it because you can't own Bitcoin in ISAs, right?
No, you can't. No,
you can't. So if you can make a great gain, and then you
have to pay some tax.
You have to pay some tax, which I'll try and keep as much of my portfolio in ISAs, and I don't like that. So that discounts it immediately relative to owning stocks in a way where you can, whether dividends or capital gains, you've got the full whack of that. So I'm probably more nay, but part of me thinks, all this rhetoric, it could, one Bitcoin could be 100K or in 2 years, 500,000. I think, it's like a FOMO thing in a way as well.
Yeah.
I think you own some, right?
I do, yeah. It's
but you probably get it more than I do.
Yeah. For me, it's the digital gold argument. It makes a lot of sense to me. And I think if you look at the properties of gold and what makes it attractive, I think Bitcoin, in my opinion, actually fulfills all those properties better than gold does. As silly as it sounds, because it's easier to transport, it can't be faked, and it's infinitely divisible. And whereas with gold, and also I think a lot of people will say, oh, you can't go into a store and buy anything. What can you buy with it? But then if you go into Tesco and hand them a lump of gold, you're not going to get anywhere. So
you might get arrested, actually.
Yeah, there's a lot of lazy arguments that I think people make. And I think also with Bitcoin, I think for me, it's very, very important to separate Bitcoin from all the other cryptocurrencies, because they aren't one and the same. They're just, I mean, Bitcoin, because it had what they call a natural birth, it's grown in a way where none of the others are really able to, because first, the problem you'd have now is if you launch a cryptocurrency where even if you say it's a better technology than Bitcoin, because everyone's looking for it, this next Bitcoin now, you get people piling in so early that it would end up so unevenly distributed. Yeah, it just wouldn't really function as a currency. And as well, you have issues typically where Bitcoin, what Satoshi did where he or she or they stepped away from it after a couple of years. Again, I think that was really important. And if you look at a lot of these other cryptocurrencies, they talk about like using the blockchain and being decentralized and stuff, but then such a large proportion of the currencies, and not just of the currencies, but of the influence, is held by the founders, that they're not decentralized at all. So no, I think it's a really, really interesting asset. And I do buy into the argument. For me, I think the best case scenario for me is if it were to have a market cap equal to gold. And I think if that were to happen, I think the price range would be somewhere between $200,000 and $400,000 a Bitcoin.
Right. Wow. Which is a big,
which
big run up from here.
Yeah. And because it does fulfill a lot of those properties better than gold as well, which is why I think it makes a lot of sense. And I think as well, if you get to a point, which we are starting to see now, where it becomes normalized to the level where if you're an institutional investor, would have a tiny allocation to Bitcoin. If you look at the supply and demand and how much money could be coming in and what that would do to the price. So for example, you had Ruffer a month or so ago where they put 2.5% of all their assets in Bitcoin. And if that becomes a norm amongst institutions, there's so much more money going in than the current market cap. So
there's certainly legitimacy, isn't there?
There is.
I think is it Square, right? They've got a big position in Bitcoin.
Yeah, they put one. It'll be a bit bigger now, but they put 1% of their balance sheet into it.
Okay. Well, I own Square, so there's a little indirect. Is that I own Square, so there's a little indirect ownership.
There's a company on the Nasdaq. It's actually a rule breaker recommendation. Have you heard of MicroStrategy?
Yes, I have. Yeah.
So the CEO of that, he's massively into Bitcoin, but to the point where he put all the company reserves in it. And now every single month he's buying more Bitcoin, because as the company makes profit, he just converts those reserves to Bitcoin straight away. So that's the way you can potentially get exposure to it inside an ISA.
Yes. There is a fund as well that is
Grayscale one.
Is it a Scandinavian one? I've read about, but I think it's you sound very convincing, because I think you've done your homework on it, right? And you get it, you understand it. So I think it's something that I would need to get my head around to really, there are a lot of other things that I just understand more and that are just more attractive just because I understand them, which isn't a reason not to buy it. But that's sort of where I am with it.
Yeah. You seem to be doing all right with stocks anyway.
You can't have them all, right?
Exactly. So one of the other listener questions was, when you discover a new stock, how does your research process usually begin?
I think I'd refer to the earlier. So it can be articles around just Googling some news articles or through Yahoo Finance, you'll get lots of shortcuts in terms of news around that company. Obviously, some of the subscribe services that I mentioned earlier do brilliant deep dives into some of the companies, the investor website. So as I said, it's a bit of a triangulation process. It's not structured. It's quite chaotic, actually. And yeah, I'll use a number of sources and try and join dots across them to form my view as to whether I'm going to pull the trigger or not.
It's not really that related, but do you subscribe to the Motley Fool UK stock advisor service?
I do. I have and I do. I don't. I mean, I think it's good, but I don't know. And I do own some of the stocks on there, but I don't. You know, I just find the ecosystem of the US ones far more attractive. I mean, in fact, you know, some of their recommendations end up being US businesses anyway, right? Not to,
They do, yeah.
you know, yeah. So which is a bit of an indication of, you know, because there's not that many recommendations that are given per, you know, the frequency. So that's a bit of an indication of how many clear opportunities there are in the UK. I think it's good, but I don't know if you've tried it. It's good. There's some good analysts, but it's not. I'm more wedded to the US ones.
No, I've got it. So I did have Share Advisor US, Rule Breakers, and UK Share Advisor. And then after the first year, I dropped Share Advisor US just because I was tending to pick more of the Rule Breakers anyway. The UK one I do quite like, actually. I probably like it more now that I've not got Share Advisor US, just because at first, because they, as you'll know, they split the recommendations into fire and ice.
Yes.
The ice ones are income and the fire ones are meant to be capital gains. And the ice ones are very good because I think the FTSE is well suited to that. But then the fire ones, I think, like you said, they were struggling with. But then when they actually first started doing the US recommendations, I was getting a bit annoyed because it was almost, I felt like I was paying for these already on the US side. And the reason I subscribed was that I wanted the UK one. But
that's right.
The US Share Advisor, I'm a bit less triggered by that. And then,
it's still, I mean,
it's nice when you own a stock as well and it gets recommended across multiple services.
It does. Well, that helps to increase your sort of conviction in a way as well, and you get more insight. I mean, the same with Seven Investing. There can often be some crossover there, and that just helps build a picture even more.
The next one is Fubo. Do you think it's still a buy?
Oh, I don't know. I have a small position. It's in the sort of moonshot area. It ran up it ran up like 120% in 2 weeks. So I didn't, you know, all this talking about I hold forever. This one I thought it was a bit ridiculous. So I took out 80% of what, you know. So what's left was my profit on that run up, and I'll just see what happens. But it's a less than 3 billion. It's a bit of a moonshot. You know, it's quite interesting what they're trying to do, almost be a sort of there's kind of sports specialist and lots of rhetoric. They're going to get into sports betting, but it's quite a high ticket price to subscribe for it. But it's one of those that, that was one of the few ones where I was probably a bit seduced by some of the noise on Twitter, and I thought I'll give it a small position, but I wouldn't be crazy to build it for a while until I had more conviction in it. What was your view of it?
I actually held it for 2 days.
Okay.
So one of the services that I subscribed to recommended it, and it seemed to tick a lot of the boxes. So I took I'll start with a small position, and then as I learn more, just because it's been quite difficult as well finding those kinds of stocks at reasonable valuations. Yes. So it was recommended by a service I used, so I thought I'll just dip my toe in, and then if I like it more, I can add to it. But that way, I'm not missing out on it.
Yeah.
But then within those 2 days, that was when everyone started talking about it quite a lot on Twitter. And the issue I had was the service that had recommended it, they quoted it at a market cap that seemed to not include the preferred stock. So it potentially had a market cap that was 2 or 3 times larger than what I thought. So I just thought, I've got too many question marks. And that it was literally, I bought it. And then literally that was when what's he called? I've forgotten what he's called. You know, like Rich, who works for like Lightshed Media on Twitter. He's an analyst, but he came out with a short thesis and described it as like the most convincing short he'd ever seen. And there's loads of stuff like this, and I just thought I'm not comfortable with this. And it actually went up by 40% in those 2 days as well. So I thought 40% in 2 days on a stock I'm not don't have that much conviction in. I'll just take the money and run.
Fair enough.
But yeah,
Fair
if I could do 40% every 2 days, I'd be doing
Yeah,
it right.
you wouldn't have to do this for long, would you? No,
Compound that.
I've kept in. I mean, it's not necessarily a good way to think about it, but I took out my initial position and I've sort of kept in. I almost consider that free in a
Free
way.
money, yeah.
Yeah, which is a stupid way because I can still allocate that to something better. But that's how if they can pull off it's a bit like Jumia. Who knows if they can pull off the thesis? If they do, then it'll be interesting.
Okay, so the next one is investing a means to an end? Do you sell to take any income, and if so, how often?
Well, there will be an end at some point, but at the moment, no, I don't take an income. I clearly will eventually, and in particular at the right point, dividend income. So, the aim, I think the aim is eventually to switch some of the more high risk growth positions into more dividend paying assets within an ISA to have, the tax-free income that gives. But no, I don't have all of my, I always hold cash if I need it on the side for rainy days. So, a few months worth. So I don't ever need. I make sure that that's a must do to have a cushion in terms of cash and savings, and anything that's I don't need to take out or anything like that. I'll just leave it there. That's my strategy. Ideally till retirement, whenever that will be.
How many years roughly do you think it'll be until you retire, and at what point do you think you'd start to switch the portfolio around to have that more high dividend focus?
Yeah, it's such a good question, and I'm already starting to think more about dividends. So I've stayed in an objective I've made for myself is to grow my dividend income 20% this year. Okay, and I want to try and over the next 10, 15 years try and grow my dividend income by around that level. If and I've sort of again got spreadsheets that compound that, and that if I do that, I get to quite an interesting dividend income within an ISA, at the age of sort of 60 or so, and of course on top of that there's pension as well. So yeah, I wouldn't mind. I've got a sort of number of 60 in my mind, but then again I've got 3 children as well to have to, who are going to be, growing up and having needs and all the rest of it as well. But I don't know. I haven't formulated a solid strategy on that yet. Just a general sense to grow dividend income over time.
Okay. It's not something I'm really thinking about at the minute either.
No, well, you're right. You've got a whole lifetime. My goodness.
Hopefully.
Well, the way you started and your age, you'll be able to finish when you're like 36 or something.
Oh, I don't know about that.
No, I don't know. I'm just.
No, if you have a year like last year every year, and the numbers soon start getting silly. But because of that, you can't have a year like last year every year.
No,
that's
you can't.
That's a bit depressing because I feel like I might have already had my best ever year.
Yeah, possibly.
Statistically, when are you going to have another 100% year?
No, true. It's not. It ain't going to happen, is it? But if you did that, then by the age of 30, you'd be the British Buffett, I think, wouldn't you? Quite frankly.
You run out of money, don't you? When you compound them at that faster rate, you soon have all the money in the world.
Yeah, exactly. I do love getting a calculator and just putting different compounding percentages and just seeing what things look like.
I've got a spreadsheet and I love messing around with it.
Yeah.
What if I just increase that by 1% more? And then...
Yeah. It's and it makes a huge difference over time, right?
It does, yeah, it does.
Yeah. So especially with your time horizon, it's brilliant.
So how many hours a week do you spend actively on your portfolio?
Not that long, to be honest. Maybe a few hours. I think I'll go out on a run a few times a week, and then I'll use that to catch up on podcasts. Where you get really good. When it's earnings palooza, as they often call it. Yeah, that kind of earnings season. You get sort of updated there. But I'll be on Twitter most days, but maybe a few hours a week probably, and then I'll have a bit of a mini deep dive monthly, and then a fuller deep dive once a quarter probably. So I'm not I'm not as obsessively looking at P&Ls and spreadsheets. I definitely heighten my focus during earnings season, more because it's fun and more for the hobby side of it as anything. It's just exciting to see, okay, who's reporting tonight? Last night it was Pinterest and Peloton, for example. It's just exciting. 9 o'clock, markets close, and you see how they did versus expectations. It's just very exciting.
It's quite a bit easier, I think, as well with some of the US growth stocks, because there's so many good accounts talking about them on Twitter. So you get a lot of people to do a lot of the work for you,
exactly.
if I'm being honest.
It's true. And this is where you're lucky, Sam, because, as I said earlier, I had teletext when I was growing up. No, maybe not in my 20s, but there's just so much. Investing has become democratized, hasn't it? It's just so, if you're willing to take the risk and do some research, everything's available out there for you to form, to get insight and form an opinion. It's brilliant. And it's surprising how many few people do, really, and especially in this country. It's an underdone kind of hobby or pursuit in a way.
Definitely. What's your favorite stock story then?
Oh, that's hard. I mean, I'd say my favorite ones are the ones that I've learned the biggest lessons from. So, Amazon is my favorite story in terms of a long-term perspective, thinking, I avoided buying that for a few years. It's too high. I'm not going to buy that. It's too late. And then it's, it's gone and, been a sort of 12 times or whatever. I think Zoom would be the other one. I bought first in late 2019, and that's the one where I've just been so lucky with timing. That's definitely the flukiest purchase ever. But the one, my favorite stock story is probably the Peloton, the sort of the one we spoke earlier, Peloton. So that, talk about going from a dystopian sexist advert that wiped off, and I just thought it was a bit of a ridiculous, to I've become this big massive fan. So it's just like the biggest turnaround in opinion about a company and a stock that you could think of. So that'd probably be my favorite one in a way.
I thought you would have said Tesla.
Yeah, Tesla. Yeah, I know. Yeah, I know what you mean. I guess it's maybe because we spoke about it earlier, and I've just sort of I take it a bit for granted in a way. So those are the more interesting ones in a way for me. Believe it or not.
Okay, so I've gone through the full questions now. So where can anyone find you if they want to follow you or learn a bit more about you?
Yeah, on Twitter, handle is at Flosser Invest. So by all means, follow and comment, and happy to be in touch.
Well, thanks for coming on the show. I think it's going to be a monster episode. It's going to be the longest episode we've ever done, actually. You've given some really, really, really great insights. I've really enjoyed it. So if no one else, fine by me.
No, I've loved it. I've really enjoyed it, Sam. So and I'll carry on enjoying your podcast as well. So thanks very much.
Right, well, thanks for listening.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.